Okay, so tonight we're going to be talking about income. Um, this is basically what it says. I mean, we're going to kind of focus on what income pertains, that we focus on with VITA, and where different forms go on different lines for the 1040, and how all that flows into being what's called total income. Basically, all the stuff that we will be inputting flows into the first 8 lines on the 1040, one way or another. Sometimes it flows through something else before it gets there, which isn't really that relevant. You'll see that once we actually start doing some returns, where it all kind of starts and ends. So what is income? Again, it's all income received in the form of money, goods, property, services that is not exempt from tax. So it includes all source income, both from the US and outside the US, from the sale of your primary residence, even if it can be excluded, which for most people it is. Um, it can include parts of the it can include parts of Social Security, and certain scholarships and grants, which we'll cover in a little bit more detail next week. Again, income that is taxable must be reported and it's subject to tax. Income that's non-taxable may have to be shown on the return, but then it's exempt from tax. So you're basically recording everything that you receive in the form of income. Again, earned income is any income received from work, either from wages or self-employment income. Unearned income, which we don't see a lot of in VITA for obvious reasons, other than the unemployment, includes income that's thrown off from investments, such as savings accounts, dividends, sale of stock, rental income. And again, important to note that unless there is an exception, all income is basically taxable. You can just kind of, even found money is taxable. Money earned in the business that is illegal, like drug dealing or selling stolen goods, is reportable. I mean, that's how they got Al Capone. So this is a chart that comes from the 4012, and these are all considered taxable income. Quite a few of these we will see off and on throughout the year. The first one, wages, that's the bulk of it. A little bit of an alimony, annuities, which are basically a self-funded pension, business income, cash income, which could be from your business or just something on the side, canceled debt, which is we'll get to a little bit, dividends. Uh, we don't really see much trust or estate income. Farm income is out of scope. Gain on the sale of property or securities, we'll see occasionally. Gambling, again, gambling, whether it's New Jersey lottery or any other state lottery or casino winnings, is reportable. Generally, it's taxable at the federal level. New Jersey lottery is not subject at the state. Hobby income, interests on savings accounts, life insurance dividends, IRA distributions. Again, we don't see a lot of that because unfortunately, a lot of our folks haven't saved for retirement. Non-employee compensation, we'll get into that a little bit more detail. Pensions, but the only pensions we see with any kind of regularity are those from the state of New Jersey, considering we live, in an area that has a lot of retirees. We see a fair amount of those, as well as W-2s from the state of New Jersey as well. Railroad retirement is a form of Social Security, which is a little complicated and only we won't go into any detail on that. Usually an experienced volunteer will do that. Again, we don't do rents, severance pay. It comes through usually through on a W-2. Self-employment, we'll get through that. Social Security, even if it says considered disability. And particularly the last one there, unemployment. Again, all of those types of things, we will see a fair amount of these, just not a lot of it in great detail or great amounts rather. So, I mean, this is what a typical W-2 looks like. Again, sometimes the layout's a little different, but this is generally what a W-2 will look like. The important thing is that there's an employer identification number, and everything gets copied or gets transposed into TaxWise as is. So for the bulk of our clients, box 1, 3, and 5 will be the same. Um, and all you have to really type in then is box 1 and box 2, which is the federal tax withheld. TaxWise will do the calculations for everything else. Um, the reason federal wages, box one, may be lower than Social Security is if there is a um, pre-tax deduction. Might be for a retirement plan, could be some sort of medical offset, in which case then you have to change how you put it in, and we'll go through details with that with TaxWise when it's up. Box 12, A, B, C, and D, these are usually for state withholding for family leave insurance and unemployment. Box 14 could be a bunch of other different things. Usually these are populated with people who work for the state. Line 15 and 16, again, these are for your state wages, which for most folks are going to be the same as box one, but again, that may need to be adjusted, and the state tax as well. Always you put in as it's shown on the W-2. There's no reason that we should change anything. That includes, unfortunately, changing the client's address. So if they move during the year and the W-2 is different than their current mailing address, we need to change all that. And if there are multiple W-2s, that can be just a lot of extra work. Again, these are some other form stuff. Again, your W-2s are basically employer compensation. That's all we really see. You want to do is enter the total wages. And that last one is key. You key what you see. Not only do you key it, but you key it correctly. So the taxpayer's address, social security number, or the ITIN must match what's on the W-2. Because remember, we're talking about matching what the IRS already has. So that W-2 that we got was already sent by the employer to the IRS. So we're just matching it. And if it doesn't match, that's what causes problems. Okay, here's some other line one items, again, types of W-2s. The one in the middle is the one that we may see. It's called the Medicare waiver payments. These are folks who get a bit of compensation for caring for a family member in their own home, which then by clicking a little button, and we'll show that when we go through some TaxWise training, exempts that income from federal tax, but includes it in the calculation for the earned income credit. Okay, so hopefully they benefit two ways, no tax on it and qualify for the earned income credit. Again, a couple other line one items, other earned income, which we'll go through here. We don't really see too much. The one that is, and actually this is on the advanced test, people who are getting a pension or retirement income that's kind of considered disability, but they're below the full retirement age, that can be considered as wages, which will, again, it's still taxed like it would be for W-2, but it will allow them to qualify possibly for some earned income credit. Again, that's a kind of, I won't say a tricky one. It's one that we see, and it's one that can get people, you can miss it. But again, that's a question that's on the advanced test again this year. So taxable interest, again, you get this from a bank or some sort of investment firm. 1099 INT will show what the total interest amount is from whether it's in stocks and bonds or some other instrument, and then any other obligations if it's on box 3, savings bonds or treasury obligations, that's going to be subject to no tax. There could be federal tax withheld, generally not. Again, we just have to enter sort of manually, and we'll show that in TaxWise where this goes. This is another way to show your interest received. Would be a 1099 composite, which shows both dividends and other distributions. As you can see there's Section 1202 gain, there's foreign tax paid, there's other non-cash liquidations. Some people who have brokerage accounts, some of these will be filled in. And then at the bottom there on the other one, there's a little bit of interest income as well, which it's less than $1, so we don't have to report that. Again, taxable interest is reported to the taxpayer in box 1. These come from checking and savings accounts, certificates of deposits, CDs, U.S. government bonds. Again, if the total of all of those is over $1,500, TaxWise will generate a Schedule B to transmit with the tax return. Again, if they receive less than $10 in interest, they may not get a 1099. Some people, because they are honest or they just have always done it this way, they bring in their end of year bank statement, and the bank statement shows that they got $6 in interest. We're obligated to put that $6 of interest in and record that as income. All right, tax exempt interest, again, that also gets reported from box 8. And again, those could be different types of um, political subdivisions that are not taxed at the federal level. Okay, ordinary dividends and qualified dividends, again, those come on a similar form, 1099 div. Usually box A, 1A and 1B are identical. Total ordinary dividends usually equal qualified dividends. Again, these are dividends are again distributions that are paid out of earnings and are sent to the client, or they could be such that if they have a mutual fund that owns a whole lot of stocks, it's the sum total of all those dividends. Basically, the key point here is that qualified dividends are generally held for over a year, and then they're subject to the lower tax rate than ordinary income, which is the better of the two, obviously. It's basically the capital gains rate. Now, capital gains distributions. There's two real types of getting these. One is the owner's portion of the capital gains that were realized when a mutual fund or real estate investment trust sold assets. So you're invested in a Fidelity fund, and you don't really do anything. You just have it fire and forget, and you get this 1099 div. It says that you created, or excuse me, shows that you sold stock. Well, you really didn't sell stock, but the manager did, and your portion of that generated a capital gains distribution, which they will have the cost basis and the proceeds calculated for you. So again, once you put that in, all that will flow through to Schedule D. And in those distribution documents, it will show whether it's short-term or long-term, which is key to determining how much of it is, at what rate it's taxed. So distributions from IRAs, pensions, annuities are reported on a 1099-R. For most people, any kind of thing that's technically a pension is going to come from the state of New Jersey. And for the most of our folks, box 1 and box 2A are populated, which is good. When it's not, it gets a little more complicated. If for some reason this is the first year that they're taking a distribution, that's an advanced topic. We're not going to get into that there because it happens very, very, very infrequently. And usually if they're having that type of situation, they're going to a paid preparer anyway. Generally, the gross distribution is the full amount. The full amount is taxable. Hopefully there's some federal tax withheld. Possibly some state taxes held as well, particularly if they're under 65. Pension income is fully taxable at the state of New Jersey. It's not in Pennsylvania. And again, the other thing that this could be an annuity, which is basically a self-funded pension. You take X amount of dollars, you send it to an insurance company, and they send you a check every year for the rest of your life. Generally, if that's with IRA money, or again, depending on the tax situation when you went in, will determine how much of that is taxable when it comes out. Again, these are types of things that we can discuss when we go through actual tax returns. The important thing, again, with all of these is we're keying in what is on the document. There's no real reason for us to ever second guess what's on that. One thing that we see sometimes is on W-2s, client will someone earn $20,000, and we see on the W-2 that there was no tax withheld, no federal tax withheld, which is going to be a problem. And you mentioned that to the client, and I'm like, well, that's got to be that's wrong. My company must have made a mistake. No, they didn't make a mistake. There was a mistake made, but not in what was presented on the W-2. That means something you need to deal with your human resources department. Okay, again, these are generally again, this is just kind of a highlight of what I went over. Again, how the money paid out from a 1090 from a retirement fund is presented to you. The different codes that there are in box 7 is key here to make sure that everything that we do is in scope. Generally, the distribution codes are one of 3. There's a 1, which means that someone took out that distribution and they were under 59 and a half years old, which means not only is it subject to regular income tax, but it's also subject to a 10% penalty. Now, there could be some ways of getting out of that, but in general, it's not. Unfortunately, we see that quite a bit. People, they have sudden cash needs. The car broke down, the air conditioner broke. They need to take out money out of their IRA or their 401k or their 403b, and they're only 40 years old and they get hit with a 10% penalty. Hopefully, Box 4 reflects that. Otherwise, they may have a serious tax bill upheld. The other key distribution code is a 3, which means it's a death, meaning so now it's an inherited IRA or retirement situation, which usually again doesn't impact the tax amount as much. It means it's just still fully taxable. And then code 7 is an ordinary distribution. So you're over 59 and a half, and the only thing you have to worry about is that it's paid. You pay the regular income tax on it. If for some reason it's coming out of a Roth, which is not taxable when it's coming out, I forget what the code is for a Roth, but that would be reflected there as well. Again, most of our folks, we don't deal with a lot of this because in our world, our clients have not been in a situation where they can save for retirement. Social Security benefits, which is something we see a lot of. This is a standard Social Security statement, even though it's from 2020, it's basically the same. Box 5 is a pink box, and that will show the gross amount of benefits received for the year. And then the benefits paid is the net of box 5 plus whatever is in this here box 3, which could be things like their Medicare B premium or the Medicare C and D, in addition to any amounts paid back or clawed back. In other words, maybe their social is being garnished for some reason for back taxes or some sort of state amount due or child support. It could be a big one as well. Okay, but this is the one that they actually get taxed on, the gross amount. And again, that's what we report, which is in the pink box. We also want to make sure that we put the Medicare premium in as well, because that may flow through that will flow through to Schedule A and the state of New Jersey as a medical expense. So maybe that'll help people a little bit, generally not, but the software does that automatically. And that last part there, the taxable portion of Social Security is never more than 85% of the net benefit that the taxpayer received. So, and the important part there is it is a fairly complicated calculation. It's based on other types of income, both taxable and tax exempt, and what your filing status is. So the good news is that is all done by the tax software, so you don't really have to worry about that. I've tried to do the calculation several times. Most times I can't get it. Lump sum payments, again, that can be a bit of a hassle because it could cause a serious tax situation for clients. This has to do with Social Security that they've been trying to get. Usually, it's when people are transitioning from Social Security disability to regular Social Security. So that could be they could get like 2 or 3 years worth all in one fell swoop, and that could cause a serious tax problem. It's generally something we don't see. Capital gains or losses. Okay, again, capital gain or losses, generated from the sale of the home, stocks, bonds, mutual funds. All that gets recorded in our capital gains worksheet in tax-wise, and then flows to both Form 8949 and Schedule D. Again, all that will get attached when we e-file that to the IRS in the state of New Jersey. Long-term gains are anything held for more than a year. Short-term gains are anything less than a year. Again, different holding periods mean that there's going to be different tax rates. Taxpayers must have cost basis either from the brokerage firm or from some record of their own. Generally, it's going to be on the forms that come from Schwab, Fidelity, whatever. On the off chance that it's not, we can try and make some sort of educated guess as to what that might be, which usually passes the smell test. Again, you sell a financial asset at a loss. you can take up to $3,000 of that loss against any gains that you may have. If you don't have any gains, you can only take the $3,000. You go, so in other words, you have negative 3,000 on the front page of your 1040. And anything above that can roll over to the next couple of years. Don't see a lot of that, but we do have a few that we've been dealing with for folks. Okay, additional income. Okay, there are a lot of different types of income, both that we do see, a lot that we don't, and are out of scope. So for instance, again, the way these are recorded, either directly on Schedule 1 or through other forms that flow through to Schedule 1 and then through to the 1040, they include taxable refunds from state and local taxes, which again only needs to be recorded if they itemize. Alimony, um, both receive and on the adjustment side paid out. Business income, other gains and losses, rental real estate, which we don't see, gambling, cancellation of debt, jury duty pay, unemployment, and other income. All right, so we're going to some of these. So see how they all flow through there to line 8, which is sort of a catch-all for line 10 of Schedule 1. So this is what that sheet looks like. So there's a lot of different types of income that flow through there. A lot of them, as you can see, have nothing to do with us. Farm income, rental real estate, foreign earned income exclusion, the Alaska Permanent Fund dividends, et cetera, et cetera. There's a lot of that stuff that's out of scope and we would never see anyway. So again, if the taxpayer did not itemize on the prior year return or did not receive a state income tax, there's no need to report any of the state income tax refund as income on the federal return. Again, we've had there's been very few over the last 3-4 years that we have had to, that folks have itemized. Generally, those are friends of VITA. Some of our tax preparers still itemize, so they would have to report it. But it's very rare that any of our clients will have to report a prior year state income tax refund. Alimony received. Okay. If the divorce decree was executed before December 31st, 2018, the receiving spouse needs to report that. Okay. You need to put in the date of the divorce decree. Again, if it's after that, it's not reportable. And remember, alimony, it's whatever's considered alimony by the court order. Child support is not alimony. It could be, instead of cash, it could be things like the spouse is paying the other spouse's medical insurance, which is not cash to her, but can be considered alimony. Okay, business income, and we're going to spend a little bit more time with this in a later session. Again, most of our Schedule C self-employed business folks are Uber drivers, Lyft drivers, a lot of delivery people, Grubhub, DoorDash, Uber Eats, Amazon, Walmart generates a lot of business for a lot of returns for us. And they're going to get paid generally direct deposit, and they're going to get some sort of indication what that total is through a 1099 NEC, which is non-employee compensation, or the 1099K, which is generally what the Uber and Lyft drivers get, and that's a third-party payments system. They may get a W-2, generally not. They should, when they come in, have some sort of records of their expenses, and it could also include cash. An Uber driver that drives his neighbor to the airport and receives $100 should be reporting that. And I mean, the thing here is, I mean, some of the stuff is, a lot of our folks don't keep records. The good news about Uber and Lyft is it's all on the app, so they can do that. The problem is a lot of people who do the delivery business, none of that mileage is recorded. There's no app for Amazon, folks who are delivering for Amazon or Walmart. It's all on them. And it's quite a bit of a mess once we get those, because we have some people who are doing quite a bit of business delivering packages for third-party vendors. Okay, real estate is real estate. Generally, all of these are out of scope. What we generally see, if there's any kind of rental income, it flows through some sort of investment product that would come via a brokerage statement. So again, not something we really don't see very much of. Okay, unemployment compensation. This is roughly what a 1099-G looks like from both New Jersey and Pennsylvania. Again, the state does not mail these out anymore. Folks can go down to um, uh, the Labor Department downtown Trenton and get one of these, or most people have them on their phone, through the app because that's how generally you apply for unemployment these days is online. So we see a fair amount of those, which is it is a valid tax document. Hopefully, there is federal tax withheld. Because it is fully taxable at the state level. It is tax-free for New Jersey. Other income. Okay, a lot more other things that are there that flow through to other income. The things that we see, gambling, gambling is lotteries, raffles, cancellation of debt. Okay, generally that is credit card debt that is forgiven by the bank. And the way to think of that is as income, because let's just say you had a $5,000 credit card balance with Citibank, and Citibank writes it off as non-collectible. So you're relieved of that burden, but as a sort of like a price for that, it's considered income. So you got to pay, even though you never got it. The point, I guess the thought is if you did have it, you would pay off the credit card balance. So instead of paying the 5,000 to Citibank, you pay maybe the 12% income tax on that. So it is obviously the lesser of two evils. And that seems to, register with people when they say, "Well, how is this income? I never got the income." It's like, well, you didn't, but which would you rather have? A couple $100 in income tax owed or paying the bank 5 grand, and usually that works. Okay, other income. Let's see. Yeah, this is generally something we don't see. There could be clients could receive a 1099 miscellaneous for one time uh, a one-time gig, so to speak. I use this example all the time. In my paid practice, I have a gentleman who every year at graduation at Ryder, he helps in the parking lot to park cars, at commencement. And for that, he gets $500. And he gets a 1099 miscellaneous. It's fully taxable. Obviously, it's been reported to by the IRS, by Ryder to the IRS, so he needs to match that. But he's not in any kind of business of parking cars. Okay, that's a good example of miscellaneous income. We have other people who come in who maybe they do some work for their church or some other nonprofit, and they get some sort of compensation. Maybe they play the piano at Christmas or something in their church, and they get a small stipend. That's not self-employment income. Okay, that is income for reporting, but it's not self-employment income. So these are the basic uh, types of income you'll see at the various levels of certification. Basic, it's going to be, again, this is the other income situation. Taxable refunds, alimony, unemployment. Advance requires, to do business income requires advance. And there's other things, some goofy income that gets thrown off. Rental real estate, farm income, we don't even do that. And there's some more other income. Okay. Again, this specific, getting more into the 1099 miscellaneous, the NEC, and the K. The one thing that the IRS and Congress is still struggling with is this notion of people who sell things online. Okay. Is it more than $600? If you sell a sofa, online for $400, and on eBay or Facebook Marketplace, probably a better example. By virtue of this argument, that's not reportable. Let's say you sell it for 800. In that case, you may get a 1099 miscellaneous from Facebook or Meta to indicate that you received $600. You'll have to offset that with the cost of the good that you sold. In this case, it's the couch, which maybe you paid thousands for, but now it's only worth $800. There are ways, and none of this is on the test, and we've only had a few of these come up where you're basically going to net those two out. So obviously, you're not going to pay any tax on it, but you're also not going to get the benefit of any kind of financial loss because it's not a financial asset. It's a personal belonging. What they're really trying to get at in this is the Taylor Swift premium. where you go out and you took down a dozen Taylor Swift tickets at 500 a piece or whatever the face value was, and now you sold them for 5,000 a piece. I think we all could agree that that is a taxable event and you should be paying tax on it. A lot of these platforms now require you, if you're selling, particularly on any like StubHub, any of the ticket vendors, SeatGeek, things like that. Whatever the local your favorite sports team uses, you're selling your giant season tickets on their platform. You have to give them your social security number, and chances are you're going to get a 1099 at the end of the year. Again, that's not something we're going to see because I think of all the things I've already mentioned. Okay, a few people have come in. They sold things on Facebook Marketplace. Again, we have a way of making that go away. Again, it's just something that, again, then they're not looking to hassle people. But again, if you received a tax document, you need to kind of deal with that one way or the other. The last thing you want is your refund to be delayed because you didn't somehow document an $800 1099 that you received for selling a sofa on Facebook Marketplace. So you'll get one that'll say look something like this, and it'll be in box 3, other income, and that'll have to be reported. And again, we're going to get through this when we do uh, tax-wise training because none of this is really on any of this is on both the advanced and the basic test. Cash prime, yeah, that's fine. Maybe generally there's not going to be any tax withheld on this stuff, which is a problem for people who get um, who sell a lot, particularly again if they're delivery people, and there's never federal tax withheld. So okay, business income when someone has their own business, generally they're going to get paid through their receipts are going to be showing either a 1099-K or a 1099 NEC. And again, if the net income is more than $400, they're going to pay self-employment tax. And we'll get into that in a minute on the adjustments. They also need to report any additional cash received for that business. Yeah, that's pretty much it. All I need there. Yeah, other income is generally reported on a 1099 miscellaneous. To the extent that depending on the size of that, it can have a really big impact on the client. One thing that I had last year, a gentleman came in with I think about a half a dozen of these, and he turns out he was working for a traveling rodeo, literally taking care of horses, shoveling out the stalls, the sawdust, all that crap, literally crap. And he had like 30, almost $30,000 of 1099 miscellaneous income. That's not something that you can just kind of say is like a hobby. So he got hit on self-employment tax on this. He owed a lot of money. And it's unfortunate. People are getting mischaracterized or categorized with their employer. So obviously, it's a lot easier for the employer to just pay him cash rather than now he's got to pay Social Security and Medicare tax as well. When you're self-employed, you're paying all that. And, on the one hand, that's good because down the road, you're going to need those Medicare and Social Security credits. But on the other hand, it's a lot of money you got to shell out all at once in April. Okay, I think that was it. Okay, that's it for that. So I'm going to go to adjustments now. So now we've got all the now we've got all the income in the return. Now we need to try and get this to a point that we can see what the taxes situation is going to be. So we basically got total income here. We want to make sure what the tax liability is going to be. And all of these things can help lower the client's tax situation. And there's a few things that we do see. Again, you're at a certain point now where you can only do so much with what's presented. So total income minus the adjustments is adjusted gross income. So in the previous slide, basically the sum of all of that stuff gets us to total income. Any increases, so the more adjustments you have, lowers taxable income, therefore lowers income tax. Again, it has nothing to do with self-employment tax. Okay, that's a whole separate category. And we'll get into how non-refundable credits help clients, but don't help them if they're self-employed. So here's a situation. A taxpayer had $20,000 in gross income. There's a $300 in the educator expense deduction, $50 penalty for early withdrawal savings, $2,000 in alimony paid, and $1,000 in student loan interest deductions. So what is their adjusted gross income? Well, $20,000 minus all of those gets us to 3350 in adjustments. So he's adjusted gross is 16,650. That's what we want to see. Try and get that number down as much as you can, provided you have adjustments that will help in that. So there's first one is the educator expense reduction. So an eligible educator is someone who's at least had 900 hours in the classroom. They could be either a teacher, a counselor, an aide, someone who's in the classroom. And again, the expenses, again, from what I've heard, teachers spend a lot more than $300 a year on classroom expenses. And that could be all kinds of this came out of COVID, disinfectant wipes, things like that. But it's generally things like coloring books, crayons, all that stuff that make a classroom a classroom. Okay. So again, you get to deduct $300 off your income for that. Okay, don't worry about you can't take that if you have if you use proceeds from Series double E bonds to pay for that stuff. If you have if you took out you withdraw savings from an account from a CD early, you get an early withdrawal penalty. That's an adjustment as well. Again, we don't really see a lot of this because our clients don't have anything that's wrapped up in a certificate of deposit. Yeah. Okay, alimony paid. Okay, so alimony paid to a divorced spouse may be deductible as an adjustment to income that reduces AGI. Again, if the divorce is before 1985, that's out of scope. We've never had one of those. Again, if it's after 2018, then it doesn't matter. Again, for it to be considered alimony paid, the ex-spouses they don't file marriage jointly. The payment was in cash, which could be checks. Again, if the divorce decree indicates certain payments to the spouse as non-alimony, not alimony, then you can't include that. Ex-spouses were not members of the same household when the payments were made, et cetera, et cetera. This is all pretty basic stuff. And of course, big thing, no child support. The few people that we've had over the last few years that are getting alimony or are paying alimony are well known. And, again, we just don't see that very often because it's just not something that comes into across our bow, so to speak. All right, again, when you put that in, you need to indicate the date of the divorce decree as well as the social of who's paying it, who's receiving. So it goes both ways. So IRA calculations. Now this is kind of old school for some of us. Again, traditional IRA contributions are deductible for 2020. Actually, it's 2024. I didn't change that. It's $7,000 for everybody, $8,000 if you're over 50. The IRA deduction comes through on Schedule 1, line 20. The problem here is, again, our clients do not have that spare cash to put in an IRA. I think I saw one last year where someone made an IRA contribution. All right, student loan interest deduction, you can deduct up to $2,500 for the year in which the taxpayer paid the interest. Again, they must be liable for the loan. This isn't something mom and dad can claim, or if they're party to the loan, they can't put it on junior's tax return. Again, they can't be filing married separate. They can't be claimed as a dependent on someone else's return. And there should be the appropriate form from the bank or whatever the loan processor is that shows what that amount is. It's a 1098E. There'll be some other adjustments. Again, only highlighting line 13 and 15. Those are the ones that we generally see. Line 12 and 14 requires military, and we don't really see any of that. Line 16 is out of scope. And 17 in theory isn't, but again, our people that are self-employed are not buying insurance, health insurance through, or paying for it on their own. So health savings accounts. All right. These are medical savings accounts designed to pay for qualified medical expenses. And again, and anything that's put in there that's growing is growing on a tax-free basis. So to have an HSA, you must be covered by a high deductible health plan, which is pretty much the norm these days. Not have any other health insurance, not enrolled in Medicare, and you can't be claimed as dependent on somebody else's return. Again, a family plan can cover both themselves and a spouse. And here are the limits to what you can contribute. And like an IRA, those can be made up to the filing deadline of April 15th of next year. So the one thing that we see in general is this middle part here. Generally, HSAs are made, contributions are made by the employer and the employee. In box 12, if there's a code W, that's been made by the employee, I'm sorry, the employer. Those aren't deductible. Okay, there's ours recorded, and they will also trigger a form 8889, which will show how much was spent on health expenditures during the year. The client should have a form from the HSA administrator, and we need to know from them if they was all the distributions were for a qualified medical expenses. Generally, they're going to respond yes, and again, that's positive affirmation. We don't need to see receipts or anything like that. If for some reason it's not, if down the road it was determined that they use that to make a car payment, they could be subject to a 20% additional tax on that distribution. Okay, self-employment tax. Okay, 1/2 of self-employment tax can be deducted from income. So after someone who's been driving for Uber, if it turns out that they're hit on, they got to pay $1,000 of self-employment tax, $500 of that can come as an adjustment on basically above line deduction to help reduce their income tax liability. That doesn't help them on their self-employment tax. They're still going to be spending at least $1,000 in self-employment tax. They may not have any other income tax, and frequently they don't, but they're still going to have to pay that self-employment tax. And when we do one on tax wise, this will all become very, very clear. Okay. So here we go. So here's a typical, I won't say a typical because there's a lot going on here, but this sort of like sums up all of this stuff here. So Pat and Chris are married. They want to file a joint return. They're each 27. There's no children. Okay, it's nice and easy. Pat teaches third grade and spent 1,400 hours in the classroom. Chris is social service manager, blah, blah, blah. The combined income was 60,000. They had $2,000 of investment income from a CD that they cashed 6 months early to pay for a new air conditioner. Okay, so they bring these expenses. So Pat had $600 of classroom expenses. There was $2,300 in student loan interest for Pat, $1,700 in student loan interest for Chris. There's a high deductible health plan. The W-2 shows $1,200 in box 12, code W. Pat did the right thing, contributed to $1,000 to a Roth. And there's a $200 early withdrawal penalty, which we know about up there because they took that out for the air conditioner. So which ones can they hope to deduct? Okay, so here are all the expenses. They have the $600 classroom expense, loan interest, the high deductible, the $1,200 contribution, the Roth, and the early withdrawal penalty. So when we go to the next slide, we'll see a little more clearly that the answer is 3,000. And the reason is only $300 can be claimed as classroom expenses. The student loan interest, remember, that's per tax return, not per person. So together, they can only take 2,500. They can claim the $200 early withdrawal penalty for the CD. And again, the other things, excess amount, again, it's not like you get to roll that over or anything. It's all in 1 year. The code W, again, that's the non-deductible HSA contribution. And she made a Roth contribution. So again, that's not eligible. So that's it for adjustments. Now I want to show you one thing, as I've been trying to do with each session, is to show everybody something a little more practical right on the test. So this is in the basic test scenario 6. This is Matt Urban. So Matt is 24. He's single. He earned $27,500 during the first half of the year. Then he lost his job and received a total of 8 grand in unemployment. Also down there, he pays student loan interest for the courses he previously took to earn his bachelor degree. So he's done. He's got a degree. He paid $900 of student loan interest. So the test questions, are basically, are Matt's unemployment compensation taxable? It must be included on his 2024 tax return. I think we answered that question pretty clearly as we're going through the material. And then on the last one, number 13, the amount of student loan interest that Matt can claim as an adjustment is, obviously, we know that the max is 2,500, so he can claim the whole 900. So again, just to kind of give a little sample there of what we're going to do. And we're actually going to talk about question 12 next week. So I think that, yeah, that was the only question I wanted to go over. Actually, there's one for the, hang on just 1 second. I think I may have had one for the advanced as well. Jumping around here. Oops. Oh, I didn't. So in advanced scenario 6, David took out an early distribution from his IRA for tuition and a $500 emergency repair for his air conditioner. So here's talking about the extra 10% because he's only 28. So there's something that, we kind of alluded to. We'll talk about that a little bit more. The other thing that we do see occasionally in the previous scenario where they took out $500 or for the air conditioner or for $2,000 for a new air conditioner. There are EV credits for homeowners. We do see a few of those, and we'll talk about those when we go to some advanced topics once the software is out. But that's just a couple of things I wanted to show there. That's it for this week. I'm going to stop the recording, and then we can have a few questions if you have anything.